Welcome to the Dividend Talk podcast, episode 100, our top 10 European companies. Hey guys, welcome back to the latest episode of Dividend Talk. Today we have a live episode where we're joined by members of the community who will ask us questions. We will also talk through our top 10 companies if we were to hold them for the next 10 years in Europe. All that and more. See you on the inside.
Hey, European DJ, episode 100. How do you feel about that?
Well, it's amazing, right? 100 means 100 weeks. That means like 100 weeks not spending with my wife. So, it became a bromance with you. And yeah, I mean, 100, it went really quick because we started, I think, somewhere in May or June 2020, right? When just the pandemic started. So, and, it has not always been that easy to find time during the weekend, but I think we did pretty well so far. So I'm actually quite proud on it. How about yourself?
Yeah, I'm quite proud. And for the change, usually it's just me and you recording. And now we've got about 16, 17 other people watching us record. So it's a little bit nerve-wracking today, I must admit. But delighted to have all our guests here today. It's really great to have such a community. We were speaking beforehand. We have everyone from somewhere in the US, North Carolina, all the way over as far as Latvia. So it's quite incredible the community we have.
Yeah, well, it was also nice to notice that when we introduced each other, that actually most of the people probably, it's not, how to say it, backed by statistics, but not don't live in the country where they've been born and raised, right? So it also shows a lot what we see a lot in Europe, specifically in the investing community, that we're all over the place effectively, and we come with so many different backgrounds. It's quite interesting for me. But having said that, 100 episodes, it's quite a lot. So do you still remember or do you still recall something which you, for instance, would mean like this is my most favorite moment of the Dividend Talk podcast?
I think having Ian Lopak on the show is my favorite moment. I remember we sat there for about 3 hours with him, and he just talked and talked. I can't remember even asking a question. He just let out so much knowledge to us. I think that's probably my favorite. It's a long moment, but one of my favorite moments on the show.
So I've got another moment which was quite epic, and that was when your wife did the whole introduction. Do you remember that one?
Yeah, yeah. So for those that don't remember, I can't remember what episode it was. It was one of our early ones. My wife made a joke singing the intro, so we just put that on air, and she's just about forgiven me after that. But tell me, European DJ, what have you learned from doing all these podcasts?
So first of all, a little bit about podcasting and sticking your neck out.
Yeah,
That's definitely one. But you know what I like so much about this podcast? I truly believe it makes me a better investor. We get so many questions here, and I've got, for instance, chosen one stock today that I would have never looked into or chosen without having got this question, for instance, on Dividend Talk podcast. So sometimes these questions we don't really prepare always, right? We try to do a little bit more work when we see a ticker
yeah,
to at least respect the person that asks, at least with really giving it some time. But often they are really thought provoking as well. And while I might come across sometimes, of course, also really stubborn because I've got my plan really built into a routine and I don't want to change my routine quickly. I do listen often and makes me thinking during the week when I'm driving to work. So all these questions and such, they really triggered me to fine tune my philosophy towards dividend growth investing. And yeah, sometimes even to change a little bit here and there. And that's really what this Dividend Talk podcast brings me. And that's way different than, for instance, a YouTube channel or a blog, because there the questions are usually related to the article more.
yeah, yeah. And definitely, I like having my opinion challenged. It gets challenged quite a bit, but I enjoy that because one, I'm not always right. I don't have all the answers, either do you, but it's good because it makes you better. It makes you think about scenarios that maybe you would not have thought about before. So that's what I quite enjoy the most about it all. But maybe just before we move on to the main topic, how long do you want to continue this? We're at episode 100. How long more can you go?
So if we do it in this rhythm with every weekend, I think I could do this until retirement, because I don't see myself stopping with dividend growth investing anytime soon. So
Yeah.
I don't know if you have any plans for the upcoming 27 years, or
Hey, you're closer to retirement than I am, so
yeah. So I'm looking forward. I think we should be able then to make it to episode 1000.
nice. Let's try it out. Okay, so the main topic then today, we picked 10 companies. We tried to pick them from one different company from a different part of Europe. I know we're supposed to pick the best company in that country. I didn't kind of stick to those rules, but we'll see how we come up with. Do you want to choose your first one? Which company and what region is it from?
So I think it is an obvious one, because I'm born and raised in the Netherlands. So I want to start with a Dutch stock. And, I continue to get back to Ahold Delhaize. It is for me one of those stocks that I'm really bullish on. It's a big and large position for me already. And actually, it's becoming interesting again, right? It's now trading around 25 euros. And what I just like is that the management is really, committed to the dividend and dividend growth every time they mention it again in their quarterly earnings. I'm curious about what they will do with the buybacks, the 1 billion buybacks that they are also doing on a yearly basis. Um, but what I also just like is, it has this bol.com asset still in there, which it wants to spin off. So I'm really interested to see what it will do to the stock price itself, what it will also do to the cash flow. I think it should be in general cash flow neutral, from what I know and what I've read about bol.com. So I think it's more like it will be nice Christmas presents for us. And then I'll decide what I will do with bol.com, of course, because it's not a dividend growth stock. At least I cannot imagine it to be. You get it now for 3.8% at this moment in time. I mentioned last week, if you want to initiate a position, could be a nice chance now. EPS payout ratio 44% and free cash flow of 60%. And to help Manoush here, who's listening to us here in the Dividend Talk podcast, it has ticker symbol AD, Ahold Delhaize. So this is
Nice.
mine. So I expect now your Irish stock, knowing
was-
you're Irish.
Yeah, quite predictable, Ahold Delhaize, wasn't it? I knew you were going to choose that. But from an Irish stock, I picked DCC Group, which actually trade on the London Stock Exchange, and a company that I did not know paid a dividend until you pointed it out to me about 3 months ago. But they have quite a good history. Over the last 10 years, they've got a 10.32% annualized dividend growth rate, which is quite something for a small Irish company. But they're actually not that small. Most of their business is in Europe. There's a small bit in America and the rest of the world, but it's quite a decent company. They're into marketing, so they're in marketing in energy, healthcare, and technology, and they buy businesses and try turn them around and stuff. So it's quite good. It's a 3% dividend yield, and for an Irish company, it's definitely a company that's on my watch list.
Nice one, nice one. And how you said, I'm curious to see when you will buy it. I'm really curious for it.
Yeah, I'm getting close. I'm getting close to buying it. Maybe next month or so.
Nice. So then I'll take the next stock. It needs to be the country I live in, and that's Poland. And this is a stock that people that love cider should really know it. And the ticker symbol is AMB, and the company name is Ambra SA. And this stock I just discovered recently. I checked several times the Warsaw Stock Exchange, and you have companies like Asseco there and such, and those companies have had interruptions in their dividends. Now, and then I think it was Piotr or someone like that, one of the persons I also sometimes meet with in Warsaw. He recommended me have a look at that. I believe it was him. And the interesting thing is, since their inception, let's say around 2008, 2009, that they start paying a dividend, it has been growing its dividend. It started with 10 groszy and it's paying now 95 groszy per share. And it has been growing every year, except for 2012 when it had a flat dividend, and 2020. And 2011 was the debt crisis in Europe. 2020 was COVID. So for me, they get a pass on those things. And I mean, it's quite amazing what they've been growing. So it is really known for its wines. And yeah, I mean, I think it's cider. I think we don't even call that wine officially. But just to let you know, the total sales volume from the first half year report that was published, I believe, 2-3 months ago, it grew 14% year over year, and their revenue grew 20% year over year. So these are really huge numbers. And if you're sitting at home, wine, cider, I can imagine. What is also interesting, that their debt increased heavily by net debt by 25%. But it gets 70% of its sales from Poland, the other 13% from Czechia and Slovakia, and the other 17% from Romania. So it's really a play on Eastern Europe. And I would say let's say just the emerging growth that you see in these countries. The dividend yield is currently 4.87% with ticker symbol ANB. So this one is one that I'm really looking at now. I've always said I would love to have a stock from Poland in my portfolio. So looking at the latest price action, this might just be it, because it's the only stock that has a proper dividend growth that I've ever found on the Polish Stock Exchange.
Nice one. And my second company came from Italy. So I don't think we've ever spoke of many Italian companies on here. So I went for one of the most iconic Italian companies you can find, and it is Ferrari NV. So ticker symbol RACE. I know you're a huge Formula One fan. Are you happy Ferrari are back on top?
Yes, but only to challenge Red Bull a little bit to give it a nice season. But of course, I would like Max Verstappen to win, right? Like today.
Yeah. I prefer Lewis Hamilton, but we'll leave that for another day. But I mean, this company, it kind of stuck out. Their quarterly earnings this month really hit me when I was looking through them. So their sales improved, I think, nearly 18%, 18% year on year, which is quite good. They have deliveries of new Ferrari Roma and the SF90 on the way, and they started paying a dividend 5 years ago, which I did not know. So the dividend is quite low. The yield is 0.76, but the growth rate is over 5 years, 16.49%. They have a decent balance sheet. You can see their top line and bottom line have been growing really good. So it has doubled since 2014. So it's definitely an interesting company for me. I mean, it has that real brand recognition, doesn't it? It's a huge brand. It's really hard to replace Ferrari. Anyone that's into cars or racing always think of Ferrari. So I'm quite excited to see that they actually pay a dividend as well.
Would you buy one if it would be covered by dividend income?
No, cars depreciate in value. But I would honestly, I would love to own, if I could, I would love to drive a Ferrari around the racetrack. I would love to drive one.
Nice. So nice pick, Derek, and to keep the speed in. I mean, if you have speed, you also need some smoking, right? So my next company would be, of course, British American Tobacco from the UK, if I would need to choose one from the UK. And you need to know, I'm having a post in the working about stocks from the FTSE 100, and there are like 20 stocks in there or something like that have grown dividends for, like, let's say, more than 10 years. And there's really not so much interesting in there. And that's why I just continue to go back to British American Tobacco, because the stock exchange, or those dividend growers, there are often energy, building materials or something like that, but nothing where I truly believe that they will do well in the next 10 years. But British American Tobacco, a technology inhalation company, as cigarette companies promote themselves right now. I just believe that also with the patent and this deal that they won in the United States, I just think they're really well positioned for the next years. I don't see them stopping growing their dividend anytime soon. I believe they did a really small hike this year. But with ticker symbol BATS, you can still get it for 6.3% right now. So if you think about current yield with some dividend growth over the next 10 years, I think it will really give you this nice passive income for years to come.
Yeah, and of course, British American Tobacco are making a better tomorrow. So how could you not have them? Cool. So you have the speed and you have the smoking, but you also need to have the designer gear, yeah. So you have to have someone beside you with designer. So my next pick was from France, and I was bored of picking L'Oreal, which probably everybody expects at this stage. So I went for the makers of Gucci, which is a company called Kering SA, or ticker symbol KER. So at the moment they have a 2.66% dividend yield. And again, similar to L'Oreal, the growth is quite good in terms of revenue. Like how many people buy this stuff? It's incredible, but it's such high value, I suppose, and anyone with money or anybody wants to have Saint Laurent and Gucci brands. So it's quite interesting. They've been paying a dividend for quite a while. It's currently €12 a share, which was up from €8 last year. I don't have the growth rates off the top, but it's quite an interesting company. It's kind of similar to L'Oreal in terms of product and what they do. So it's one I would pick from France instead of L'Oreal, of course.
Oh, having a Gucci beside you on the, what is it, left side in your car, in the Ferrari?
Yeah.
Yeah, because you're in Ireland, right? So
Yeah.
having a Gucci there, a nice one, a little bit blonde, wouldn't be bad. This car needs to be fueled as well. So I would do this with the company from Spain, Enagas. I mean, it's maybe not oil, but probably you will have a gas driven Ferrari, right? So Spain is also such a difficult country. You usually end up with utilities there, because the other one would be, for instance, Red Electrica or Inditex, but I believe they cut their dividend last year. Not entirely sure. And this one would be a pure yield play. It's almost yielding 8% right now. They did pretty well over the last year as well. They are still committed to their dividend until 2026. After that, we'll need to see. There's a lot of political risk here. And this might even become more now with what's happening in the, oil and gas industry. But it is the harbor, let's say, or the port of natural liquid gas into Europe, right? So, and there's all the transport for it as well. So I'm quite actually bullish on this one. Also, now we know what's happening to the gas prices and liquid natural gas. So, in my portfolio, I have also Royal Dutch Shell. They pump it up, right? They ship it, and then they bring it to Enagas, and then they distribute it to the houses, to some of the real estates. I don't know, Vonovia in Germany or something like that. But although I don't think they get that far from Spain. Almost an 8% yield. I have it in my portfolio. It's a little bit dead money if you look at the share price, but it's already an 8% return just in passive income. So I like some of those high yielding stocks. I just don't have a lot of expectations towards real dividend growth here.
Cool. My second last company came from Switzerland, and it's Roche Holdings, which is kind of a research-based healthcare company, obviously headquartered in Switzerland. I really like a lot of Swiss companies, but my problem is the high dividend tax. So that's why I don't invest in any of these, and probably why I would not invest in Roche. It costs me 30% tax. It's like investing in eToro, for example, that charges you 30% anyway. So it's a shame, because there's a lot of good Swiss companies out there. But if I was to choose one company from Switzerland, it would be Roche Holdings. I really love what they do. I know they are heavily involved in research. They are operating all over the world: China, Europe, America. They're doing lots for diabetes, which is close to home. I know lots of people that suffer that. So they do some good things. They also have a pretty good balance sheet. Revenue is growing, although slowly. It's still growing, and of course they have a huge, can't remember what it is, 40-50 years dividend payments as well. So it's quite an interesting company. It's just a shame about the dividend tax that I'd have to pay on that company.
Yeah, and then in that case, I always recommend to look also at dividend yield after tax, right? Because sometimes you have higher yielding companies in high tax bracket countries. And if you think from a compounding point of view, then looking at the yield after tax might still be a good alternative to not be totally distracted by the tax.
Yeah, but I still find it hard to hand over 30% of my hard-earned money. It's it's still a lot to take.
And isn't Switzerland 35%? Might,
Could be 30.
yeah, might even be more. Yeah. Good. My last European stock will be from Sweden, and we have some Swedish listeners here. And of course, it's Castellum. I mean, 24 years of consecutive dividend growth, right? Not even pausing it for some time. You get it now at a yield of 4%. So that's quite a good price. And I believe it's at a 2-year low or something like that. It's trading around 190 Swedish crowns, ticker symbol CAST. I mean, I like this company a lot. What I also like is that they are doing really targeted acquisitions in Scandinavia, and at usually really lucrative deals. Yeah, and this is how it's also growing a lot. There are some people that are really fan of management there, of this new CEO. I forgot the name. I looked him up a little bit. He's charismatic, I must say, but sometimes I also get a little bit of allergy there, because when I read the annual report, the last one, it was like he was just self-praising him, and usually this leads to trouble over the long term. So that's probably my biggest risk, having such a CEO there. But I think the business is really sound. It's in the office space, so there's some risk associated there as well, probably with working from home. But generally 4%, if you want a real estate company in your portfolio, I would choose definitely Castellum over Vonovia, which is also really popular in the dividend growth community.
Cool. Then my last one comes from Germany, and it is Siemens, so ticker symbol SIE. Siemens are just an industrial powerhouse, aren't they? They're all over Europe. They're involved in digital industries, automation. They have Healthineers, infrastructure. They pretty much cover a wide range of areas. I think they're a huge company. Little bit coming into fair value, actually. I think they're trading at 115 euro, which is about 11 or 12 PE ratio, which is quite good. Dividend yield is 3.48. They did have that dividend cut, I remember, maybe 2 years ago or last year, which was quite small, but they still have an impressive dividend history. But it's, as an automation engineer, I use their products quite extensively. A lot of their robotics, PLCs and stuff. So it's a brand I'm quite familiar with. And if I was to pick one company that I would just buy and forget about for 10 years, it'd probably be Siemens, of all the companies I chose today.
Yeah, I think it's also an excellent play on the new energy market, right?
Yeah, of course.
We were talking the other day about, the main people earning from the gold rush were the ones selling shovels. This is Siemens for me, when you think about the energy transition in Europe. I really believe that they have all the equipment there. Even if you look at public transport, they're really strong in this area. And I think they're better than their French competitors and such. So
Yeah.
I truly believe that they will give us lots of pleasure as dividend growth investors. And they cut their dividend technically because they did the spin-off of Siemens Energy, right? So that's a bit of a bummer. But on the other hand, I said it's not a reason to shy away from them.
No.
But hey, these were 10 European stocks. I hope people enjoyed these, but we shouldn't be excluding our friends from America, because there's also a large part of American listeners that tune in every week to the Dividend Talk podcast. And we have also one listener here today, is Brian. So if you think about a 10-year stock, an American dividend growth stock that you would need to hold for 10 years, which one would be yours?
Microsoft or Texas. I'll go Texas Instruments. I think Texas Instruments are quality company. I mean, for a calculator company, they did quite well, didn't they?
Yeah, definitely. It would be mine as well. So first of all, let me explain why I wouldn't choose Johnson & Johnson, right? And I mentioned it several times before. They're spinning off their, consumer business this year. So it becomes a pure play biotech company with some diagnostics or medtech, right? When I look at their pipeline, they don't have the strongest pipeline in the world. Yeah, you just mentioned Roche before. It has a much stronger pipeline, in my opinion, than Johnson and Johnson. So if we look back at its history, yes, Johnson and Johnson has always been, how you said, predictable, really iconic. But if I would need to hold it for the next 10 years, I wouldn't like to put a play on Johnson and Johnson's pipeline. I would rather go for Texas Instruments, knowing that the chip industry is still, it just really needs to grow with everything going digital going forward and everything we want to track. So for me, Texas Instrument with ticker symbol TXN at a current yield of 2.7%. I believe their cash flow was growing with, what was it, on the last 5 years with an 11% on average. And I believe they're looking at a 14% or something like that going forward. So for me, the yield, including the growth, is way more attractive. And knowing how strong the business is going forward compared to Johnson & Johnson with their pipeline risk effectively.
Cool.
Good.
So that was our 10 companies. We kind of tried to get through them quickly because we're quite aware. We've got lots of people here, and we're going to open the floor up to some questions. So if anyone would like to maybe raise their hand and ask a question, fire away. Okay. RHC.
Yeah, how's it going? It's Ritz. Yeah, just a question that popped into my mind now while you were pitching the companies. To what extent do you look at global economic trends or macroeconomics when you are looking at buying a dividend company?
So not a whole lot initially. So really, it goes through my screener, which I use Kyfin at the moment. That's my first thing. I have all my screeners set up. I think we discussed on the show all of our screeners. Once it passes that, I will probably buy a small stake in a company and then start following them a little bit more in depth. And then at that stage, it's probably looking at more global influences, macroeconomics, and so on. They don't have a huge bearing in them. They should do, but I'm just probably not as clever as some guys. So I tend to just look at the underlying business, see what I think where their business will be in 10 years, and make my decisions based on that, not over what's going to happen in the next 3, 4, 6 months.
All right. So I can just add here a little bit. I typically would say I wouldn't look at it when it's, for instance, a consumer staple. But what I do look at is, for instance, oil companies, materials companies like BHP Billiton. I don't want to buy them in the top of the cycle. So that's where I really look at this element of it. Oil is a little bit difficult now with the supply chain and all what's happening around the world. But I don't feel adding to Shell right now at 27 euros when I know that maybe in 5 years, within the next 5 years, I can buy probably again at 20 euro. Other than that, I look at the company individually because I truly believe that it's a market of stocks and not a stock market. And if you follow a dollar cost averaging strategy, then I just want to deploy cash every month. And otherwise, I would start to time the market if I look too much at the global macroeconomics. So a little bit of it, but generally not too much.
All right, cool. Cheers.
I believe also, George, you had a question, right?
What are the possibilities for a full recession coming up next year or next month, according to how the economy looks around the world? COVID, war, and inflation.
So, I'm not an official economic, let's say, but if I need to understand the headlines, everyone is saying that we should reach a recession. And I believe a recession is 2 quarters in a row of decline, right? It's really hard to say, George. If I think logically, what I'm seeing around me, for instance, in Poland, right, we had something called Nowy Ład. So that's it's higher taxes for, let's say, upper middle class and above. I'm part of that. So my income dropped with 8% net. Take on top of that and almost, 10 or 11% inflation. So my earnings power would be almost down, 19%. It does influence my behavior. Also, the oil and gas prices are almost 60% higher now. My mortgage went from 2.5% interest rate to probably 8% this month. So yeah, it means I have less buying power for other things. Now, if I see this also around me with people locally that I work with in Poland, people are just spending less on certain goods or postponing. And if this is an early indicator for a recession, then a recession might come. I also read that in New York, there are less people going to pole dancing clubs at the moment, and that seems to also be a recession indicator. So if you combine this all, it seems that something is on its way. But I don't know if this also means a strong stock market decline, George, because sometimes a recession follows already when the stock market decline already happened. So it might also be a delay to the stock market. So it's really hard to predict from that point of view going forward. Derek, how's it in Watford? Any people keeping the hand on their wallet?
Not from what I see at the moment. I think a lot of people are still spending their COVID checks over here. As you said, I'm getting renovations done. I know quite a lot of people around me are getting renovations done. Went shopping all weekend. All the shops are full. Everybody seems to be buying. The pubs are full. So when the pubs are starting to empty in Ireland, then you know the recession is on the way. But at the moment, they're still quite full.
Nice. Thanks for asking, George. I hope it helped. Then the next question, maybe from Alexander.
Thank you for great value so far with the interesting picks. So my question is about margin trading. I mean, margin investing. That's different. So I did some math, and it seems to me like if you have an account on Interactive Brokers, which I believe you both have, then taking like say 10% margin, it looks to me like it could increase your return by say about 1% a year, which is of course huge. So my question is, are you using margin at all, or are you just like staying away because you consider it to be like too risky? What's your opinion on that?
I typically stay away from it. I consider it risky. I think I mentioned before I tried some Forex trading before, which obviously has high margin, and I got burned pretty badly. That was in my younger days. So for me, it's about risk reward, and yes, it's easy to look at the math and sometimes think, okay, you earn an extra % a year, and this is going to be huge, but there's also big risk to that as well. So I prefer to just spend what's in my pocket and just leave it at that. At least I know what I can lose. If I start going into margin, start getting ahead of myself, thinking I can beat the market, I'm pretty sure I would end up in all sorts of trouble.
So I have it only a little bit for option trading, the margin, both on the Giro and Saxo Bank. And on Interactive Brokers, I was not qualified for margins. I don't know. I had to fill these forms, and seemingly I'm too much amateur to even be considered. So they closed everything.
You didn't lie enough on your test, basically.
Exactly. I failed on the test. So seemingly I'm not good enough for that, Alexander. But to the point, I don't like investing with borrowed money. I rather have a strong cash position. I see myself more like a company with cash on the balance sheet, not to leverage like Microsoft or something like that, because it gives me flexibility in life. I don't need to worry about anything there, that anything could go wrong. The worst that can happen is that my portfolio would go to zero. But if that happens, I think we have other problems in the world. There will be total anarchy, and we will be fighting for our lives. So I'm really conservative in my investing style from that point of view.
Okay, thanks for that.
Okay,
Manoush, I see you have a question.
Yeah, I'm close to getting to a point in my portfolio where I have a group of very solid companies that it's getting to a point where when I accumulate some cash from dividends, I hold it and wait for those core holdings to get to a good buy price, like a dollar cost average. And when new opportunities come to add a new holding, most of them don't seem to be as good. That makes me want to add another holding. I just I reallocate cash from dividends back into my core portfolio. I just wanted to ask you guys whether your portfolios are at that stage. Is there a maximum number of holdings that you're looking to get to? So do you have a core set that you generally will reinvest into rather than adding a new holding to your portfolio?
I can take this one first, Manoush. So yes, I have a list of 40 stocks that I would like to own and that I want to deploy cash in. And what I have on my brokerage account, I've got trading orders outstanding. and I wait them to be triggered. And this is usually done also from the dividend income. So you're really spot on. I do something similar. I have been lately expanding a little bit in my portfolio because when I'm all the time analyzing companies, it's really like a candy store. So sometimes I can't leave the candy on the table. So I need to do some housekeeping again. So one of the stocks, for instance, I bought one time that I want to get rid of again is Kimberly-Clark. But beyond that, if sometimes it happens that, for instance, that month the stock market went only up, right? And then it didn't trigger any of those companies that I would like to buy. Then I'm still really in a rush by the end of the month to at least deploy the cash from my salary to make sure that I continue to dollar cost average, because I don't know what will happen next. And yeah, it might mean that I pay a little bit then above the initial price that I would really love to have it, or I'll buy another company that was not maybe in, let's say, the few select core holdings that I really would like to grow in a lot. It's also really a question between what's the fair value price of that, right? Because for me, reinvesting at the moment in, let's say, an Apple or something like that makes no sense. It's just way too expensive for me. Also, the yield is way too low.
Cool. That's really good to hear. Thanks for that. I think this is the first year since I've been investing where I haven't added a new holding. I've looked, obviously, I analyze, and they just don't seem to be on the level of my core portfolio. And I'm actually glad I did, because now we have a market downturn. A lot of my core holdings, the prices are within range of, allowing me to dollar cost average back into my core holdings. So I'm actually glad I took that approach this year.
Nice.
Yeah, so maybe as a statistic, I have, I think, 44 or 45 companies right now, but my top 10 companies is more than half of my portfolio. And that's really where my conviction is and where I would love to spend more.
Great. Thank you. Thanks for that.
Tim, you had a question for us?
Hi, yeah. Yeah, just first of all, comment to the podcast. Just a great show, and thanks for what you do. I'm maybe the newest newbie here. I started investing in dividend stocks in February this year, so I'm pretty new to it all, but thanks for everything you do. And probably if I hadn't have found your show, I would have probably got on the wrong track of investing somewhere else. So I appreciate it very much. Yeah, my question was, it was a bit based on, being a parent and thinking about leaving, something for your kids, and this being the 100th episode. The question was, if you could choose 3 companies that you think would be here in 100 years' time, what would they be and why?
Cool. So the gift I would give my kids is the power to choose their own portfolio, which is what I do. I let them choose. But if I was to pick 3 companies, McDonald's would probably be one of them, because I think they'll be around. Coca-Cola will always be around. I'm just trying to think of companies that my kids will know and like, and probably, I don't know, who else would they know? Maybe Disney, or Microsoft. They would be companies that would resonate with them now, that they would be able to associate with and would have no problem holding onto those companies. By the way, it's awesome that you've started in February. It's welcome to the dark side.
Congratulations with that, Tim. I would really second Disney. That's the only company that comes to my mind when I think about my children. I think the brand is there to stay. And really, I wouldn't know any other company that can easily last 100 years. I think it gets back to utilities, waterworks or something like that. But if I think about technology stocks, I think they fluctuate too quickly. IBM is one of those that exists that long, but look at how the company pivoted over the years. Microsoft might be such a company. I don't know. Consumer staples, they usually get purchased here and there and then spun off. So those companies, like how they look today, will definitely not look the same as 100 years from now. So it's really hard to answer, but I will probably also let my kids make their own decision. And also, they need to live up to their own problems later. So that will be one of those.
Awesome. Phil, I think you had the next question.
Yes. Hi, Derek. Hi, EDGI. First, also big thanks for 100 wonderful episodes. And I think I'm speaking for a lot of people here that the podcast is certainly, a part of the weekly routine. I mean, I can't wait for Friday evening, Saturday morning, or Sunday morning, whenever the podcast is ready. I put my headphones in, I go out for a walk, and really enjoy it. So definitely, cheers to you. And my question for tonight: if you had to choose between two parameters, more specifically balance sheet and realistic growth perspective, what would you prefer these days?
Right now, I would choose balance sheet. That's quite a tricky question because technically I want both. I really want both, but I would if I had a gun to my head, I would choose a rock solid balance sheet right now. It would give me the best chance of a company surviving the next 10 years.
Yeah, +1. Nothing to add there. +1. Good. Thanks for all those questions live. Feel free also to ask some questions later, but now I'll also take some questions that we got from, I said, via social media. And the first question is from Nighthawk. And, he's asking, because I asked on Twitter today, like if there would be 3 stocks that you want to hold for 10 years, right? The Buffett way, the market closed. He's asking, like, why not have a portfolio just out of 3 stocks? So what do you think about that, having a portfolio of 3 stocks?
I don't think I'm a good enough investor, or how would you say, an analyst of companies to only hold 3 companies. I suppose the reason why I have so many is diversification, that in the eventual case I get maybe 2, 3, 4, 5 wrong, I will have another couple of companies there to make up the gains of that.
Same here. This would move my portfolio from sleep well at night to not sleep well at night.
Yeah.
Yes. So it's. I would love to be able to say yes, I have the guts for that, or the balls, let's say.
Elephant balls, as it's been quoted in the chat.
Okay. Then the next question is from Rafa, and he's asking, what are your main qualities or metrics for a tier 1 company in your portfolio? So maybe for the more newer listeners around here, we have often mentioned that we have kind of specifically myself, when I designed my portfolio, I have 4 tiers, and the tier 1 are the top 10 stocks that are really the anchor of my portfolio. So when you think about that, Derek, what are the main metrics or qualities you look for in those companies?
I think it's quite similar to that episode we had when we discussed what we look for in companies, but really I want to see growing top line, bottom line, strong balance sheet, low debt, good growth prospects. And that's why you have the likes of Johnson Johnson, Microsoft, Texas Instruments. They got all those things in abundance. So that's typically what I want.
Yeah, it's what we call moat, right? So for me, it's also brand stickiness here. I think Apple has something around it, for instance, that Samsung doesn't have when we think about iPhones here. Okay, the next question is from Maarten, and he is asking, what is the highest allocation of a single stock in your portfolio history? And in hindsight, would you have bought more or less of that stock?
So it is Shell, and if I had those elephant balls we were talking about earlier, I would have just lumped all my cash into Shell at the time. I think I bought them for 10 euro. It's now at 27. So hindsight's a wonderful thing, but I'm happy with the purchase I made. I bought 200 shares or so, so I'm quite happy with that.
Yeah, it's funny, but it's exactly the same company for me. It almost makes up 10% of my portfolio right now. I think 9%. I'm already a bit more diversified. And I hope the rest of the companies will grow so that it goes down to 4 or 5% for me, Royal Dutch Shell. Okay, then.
Declining Capitalist had a question, but he's here live, so he might want to ask us himself.
Yeah, my question would be, what do you consider your biggest learning experience?
My biggest learning experience is to understand what I'm buying and why, and not just to follow because we get so many companies here, and it's easy to just jump on the bandwagon like I did early on following Dividend Growth Investor, but it doesn't work out too well, particularly in these down times, because when a stock plummets, that's when you need to understand why you have it and why you want to keep it. Without that, I would just panic and probably just sell everything. So that's my biggest learning.
For me, it would be to choose an investment strategy that really closely aligns to your own character, who you are as a person on this planet. I remember that, and I spoke about it several times before, when I was like 25, colleagues at work were buying some stocks. I bought some stocks, €100 KPN, I remember. I was nervous when it went 2% down. I was like checking the stock market all day long. And now I'm deploying like €1,000 per month, like it's nothing, right? But I know what I'm investing. It's my strategy, and it follows my character. Conservative, maybe not from a political point of view, but at least how I approach things in life. Dutch, so also a little bit cheap, wanting $1 for a penny. So I think this is really important that it mimics your character.
Well, thanks. I have another question, and that is, what question did you have you received for Dividend Talk, which puzzled you most?
So there was one a couple of weeks ago, I think, live on air. I called out the ticker symbols of countries. I thought they were companies. And European DJI had to correct me, so that puzzled me quite a bit. I think they were Baltic State tickers, weren't they, at the time?
Yeah.
Yeah.
So there's a question that we get regular, and that is around growth stocks, like pure growth stocks. What do you think about this growth stock? And I'm puzzled by it because I said we have done so many episodes about dividend growth stocks and dividend talk, and we still get a lot of questions from time to time about growth stocks, and we're both totally not interested in it. So it puzzles us often because we don't know what to answer. Not at all, because we don't study those stocks. And I think we had Strap on 2 weeks ago. So I still didn't look up what the company stands for. Did you check it, Derek? No. So yeah, it shows also a little bit the interest from us in these kinds of stocks, the Kleine Capitalist. Yes, I have Alphabet and such in my portfolio. That's totally true. So
okay.
Good.
The next question is from Cohen, who has asked us our thoughts of AO Smith Corp, ticker symbol AOS. They're one of the world's leading manufacturers in residential and commercial water heaters.
So this is one of those companies that I heard the name of, but never really checked. So it's ticker symbol AOS, in case you're curious. It's trading at the moment around $58. It has a yield of around 2% and a forward price to earnings of 16%. What is interesting is that the company was trading around $85, like, 3-4 months ago. So on the surface, you would think like, okay, price decline, yield could be higher. It's not meeting my screening criteria. But then I went a little bit underneath it, and what I really liked were their cash flow numbers. So their free cash flow per share in 2017 was $1.34, and it grew almost uninterrupted to $3 now. It had a little bit of a decline after the reopening, but this means like a doubling of cash flow in 5 years, and quite sustainable here as a level. So from that point of view, I really liked what I saw, but it should still grow a little bit, or let's say decline further for me to be attractive if I really want to consider it as a new stock in my portfolio, because then I want to see a better yield for a company before I really start studying it. And it comes to the question from Manoush, like, I have already 40 companies in my portfolio that I need to keep updated on. So another company here must be really attractive and really passing all my screening criteria.
Yeah, I agree with pretty much everything you said. It's one of the first companies I actually studied and analyzed, so I probably would not trust that a whole lot. It was about 2 or 3 years ago. But I do remember it was a really good company with good cash flows, solid dividend history. I just opened TradingView, which I have, and I have my fair value prices marked out, and I have a fair value of about $41, so it still has a good bit to go for me to look at them again.
Cool. So the next question is actually the same from both Dividend Newbie and Marek Nazarko, and he's asking if we ever met in person.
Not yet, but hopefully this year.
Yeah, so we're aiming still maybe late this summer to meet with some people of the Dividend Talk community. We have a chat also on Dividend Day, and we'll also reach out to Facebook by that time. So hopefully maybe in August, September, it will be really cool. And then I can see how tall you actually are, because this is the thing always when you get back to work now, right? Suddenly people are taller. And I believe in Ireland, you say the height of your body in centimeters and the height of your wiener in inches, right?
Yes.
So
yes.
I'm interested in the centimeters here.
Cool. I don't know what I'm in. I'm 6 foot, exactly 6 foot.
Oh, fuck. So I'm 183 centimeter.
So
Yeah, I have no clue what 6 foot is. Good. Then the next question also from Marek is like, if a company has made a loss in a certain quarter, right? How can you calculate then a discounted cash flow? Do you look at previous earnings? And he gives as an example Amazon. So yeah.
Yeah, go ahead.
I can answer, Marek. First of all, we look at cash flow, not at earnings. So that's probably already good to mention. But sometimes it happens, and you see this a lot with cash flow. We saw it with Walmart, we saw it with Target. They all had negative free cash flow this quarter because of increased inventories, right, on the balance sheet. So they had to buy more inventory and pay more for it. So this goes into working capital, and working capital fluctuates over the quarter. So it's better already to look at annual. On top of that, it's better to look just over the trend in years. And sometimes a company has a one-off. It can also be in the earnings because they maybe acquired something, or they had a liability that they had to pay something. Think about Johnson & Johnson with opioid. So I think you always need to look at the story and why that was. So usually I look at the numbers, and then when I see something awkward, I go into the searching the news, what happened there, to really understand what's the reason. And based on that, you can really judge whether it was a one-off or whether structural. Whether structural, I would look at the 5 years average free cash flow, annual free cash flow, and then take that as a number, and then see if you can extrapolate anything of this into the future with a growth number behind it.
Cool. A follow-up to that question was, which sectors would you prefer for the coming months and why?
Well, I like the fact that consumer staples are being hammered right now, and the inflation costs are really hitting them hard. So, I'm really going to look into this again. I'm not sure yet whether that makes them buy worthy. I still need to get my hands around it, whether this is like, how is it? Whether their profits have just now been reduced by, let's say, 20-30%, and that will be the new level to start thinking from, and maybe that's why they deserve lower prices. But if you think about something that has my attention, it's the consumer staples right now. And one of the reasons is that I would love to own Walmart somehow. It's one of those iconic companies as well. So I'm a bit biased there.
Yeah, I think transportation has some potential. If you look at all the annual reports or reports that we're seeing now, we're seeing an increase in costs, and obviously they have inflation, but they also have shipping and transportation in there. We know this war in Ukraine is going to affect the delivery of oil from Russia into Europe, so we're going to have to get that from somewhere else. So maybe someone like Starbuck, who they're a carrier that takes oil from, I don't know, maybe Australia, ship it to Europe and so. So I think transportation has some potential. If I was paying attention, it would have been probably to make that assumption 3 months ago, because a lot of these have shot up in price. But we saw, for example, ZIM. We get asked quite a lot about that, and shipping rates went up, high dividends, and that might follow suit with some other the shipping companies. So I think transportation has some legs maybe for the next few months.
Super. So the next question is from HKTR, and he's asking, do you think that price to free cash flow is more trustworthy than price to earnings ratio?
Yes. you can manipulate earnings. It's harder. You can still manipulate cash flow, but it's certainly harder. It's easier to trace back. So I would prefer price to free cash flow over price to earnings anyway.
Yeah, or General Electric was able to manipulate both quite a lot, but they did also really an effort for that. I read the book Lights Out, and they would just on the last day of the quarter quickly make some payments or something like that, so that it looked stable. And there was really nothing behind it, some internal shifting of accounting, and it looked all good. So, but then you are really talking about companies that are, in my opinion, doing fraud. General Electric has never been, put in jail for this, or the CEO. So unfortunately, it's not been proven. But if I would need to lean on trustworthiness, I would also go for price to free cash flow.
Cool. Dave S has asked us, how are you thinking about your allocation in a rising interest rate environment? Are you still sticking 100% to dividend stocks?
Yes.
You're not 100% in dividend stocks, though. 90%.
I have also some cash, if that's what you mean. And I have 10% of my portfolio in growth stocks. But these, I would rather say even value stocks, because this is like Meta, Google, and yeah, Alibaba. I mean, it's even more value than it was at $170 of an average price. So yeah,
cool.
No, but sometimes I'm thinking about real estate. But for me, the Polish real estate market is far from interesting. I can better buy Castellum at a 4% yield than putting all the effort in buying an apartment here. But if or when, I don't know what's better here, it would ever really severely crash here, and we would get, like, let's say, a yields of about 10%, I might also consider taking out a loan for a small apartment here in the village, just to diversify a little bit and maybe give it also as an inheritance to one of the kids.
Cool. We have another question then about Qualcomm. Are they on your radar at current prices?
No, they were on my radar 6 years ago when they had this, 5 years ago when they had this patent fight with Apple. You could really get it for a 5% yield at the time, and I was about to buy it, and somehow I even had the order outstanding. It didn't get triggered, and this was one of those moments of being penny wise, pound foolish. So another learning, you can wait also, like you can buy for 1% more sometimes a company and not be too. Although on the other end, the kleine capitalist is sometimes, I think, jealous on my stock picks, because I do have those purchase orders always outstanding. I think these were all the questions from social media. So I think we can do still 1 or 2 questions here from the live audience, if anyone.
Yeah,
Hi, Tim.
Yep.
Hey guys. I'm living in Denmark, and one of the companies I'm looking at is Coloplast, of course. A very solid healthcare company. But so my question is, a company like that, their 10-year average PE is around 47, right? And their 10-year average price to free cash flow is at 43. Their 10-year price to book is about 20. Company like that never almost comes under 20 PE. So would you suggest I just chip in every month, or wait until there's large corrections and then go in big with them, or what would you suggest?
You go on, Derek.
Yeah, it's quite a hard one, because I know this is a quality European company. I think European DJI spoke about them before, and looking at my screen right here, they tick all the boxes straight away. They have growing top line, the bottom line is growing, solid dividend growth. Free cash flow per share is growing as well, which is showing free cash flow is growing. So these companies always seem to trade at a premium, and Microsoft and Texas Instruments, I would say something similar to your question. I always find them overvalued. They're always trading at high multiples, so I nibble in at them 1 or 2 shares every month, and then I hope for a big correction where I would buy a lot more of them. I find, these type of companies will probably be worth more in 10 years' time. So you're probably getting at a bargain now, even if the PE ratio doesn't suggest so. That's just
So
what
Tim,
I do. Yeah.
yeah. then I would stay away from it. I really love the company, but there's no stock for me worth 40 PE with their growth numbers. And I believe that over time, one time the stock will have to come down to a reasonable price. And because I think an opportunity costs. I know you're Danish, living in Denmark, and you have Coloplast there, such a national pride probably to invest in it. But you know, there's also this other saying, don't fall in love with a stock, right? And I think it's never worth overpaying for a company with that much. I mean, if it has the growth numbers behind it, like if it's growing also with 20 to 30% per year, it's another story. Yeah, then you really take a bet on a 10-year growth. But otherwise, I would just leave it. And I mean, I bought Microsoft at a certain time. I bought Apple at a certain time. All these stocks, once in 5 to 10 years, get beaten up for whatever reason. And that might be your time to initiate positions and then be aggressive, right? If you're really having this conviction. But I had to learn what conviction was, right? I didn't have a feeling for it in the beginning when I started investing, but I started to spot some things in stocks. But you know, on the other hand, I have a lot of conviction on Alibaba, and I'm 60% down. So it doesn't mean I'm always right with that as well. And that's a bit about it.
The hard part about that is that these companies that are trading at a premium, when they start dropping hard, investors tend to get scared and do not want to buy them in those moments. And it's easy to sit down and say buy them when they drop, but when they start, if they drop 20%, for example, there's probably a reason or there's something happening.
Exactly.
And it is harder to buy them in those moments. So
yeah,
it is a trade-off. I just do with Texas Instruments and Microsoft. I think they're overvalued. I just plug away each month, hoping they come down. That's my approach. I don't know too much about this company to tell you to buy or not to buy or to stay away. I just kind of want to share what I do with high value companies. Okay.
Derek, we also got a message in the chat here because Ola is not able to use the mic.
Okay.
And he is having a question, and he says like, so he has approximately 40% of his money in dividend stocks, mutual funds, robo-investor, and some other random stocks, 10% in non-listed investment, and 50% in cash. There's quite a significant amount of cash. Is now the time to start buying dividend stocks, let's say, with lots of cash?
It's a hard question, isn't it? If it was me sitting in that position, I probably would put a little bit more in, particularly on maybe some of the consumer staples that have dropped. I would ease myself. I would certainly not be putting, if I had 50% in cash, I wouldn't be putting 20% of cash in. I would just ease into the market and see where it goes. I do think we are in a downtrend. I think it's going to affect the wider market for a period of time until we start to see that turn. So we could see prices go down a little bit from here as well. So I wouldn't be particularly in a rush. And I would focus on quality, strong balance sheets, and strong growth prospects.
Yeah, I have this actually every year we get a bonus, right? At work, at least some of us here in the call. And I do the same with a bonus. When I get a bonus, I spread it out over 12 months and I just increase my, monthly contribution. I think if you have a windfall, like, I don't know, selling a house or an inheritance, I would spread it out over 2 years and just like take the number, divide it by 24 and make that your monthly contribution. I would do something like that. You avoid timing the market in the wrong time. I do believe that there are enough opportunities now in the stock market for dividend growth stocks.
Ollie is also looking for a T-shirt with point of view written on it.
Yeah, we should do something like that. Good. The last question then from George, and then we'll are at the end, let's say, and he's asking Walmart or Target. Which one would you choose?
Right now, I would choose
They
Target.
drop more than 30%, right?
I would pick Target right now. I think they're closer to an acceptable value.
Yeah, same here as well.
Okay, cool. Thanks a million to everyone who turned up tonight and asked questions. It's quite surreal actually sitting here talking to European DJI in front of an audience. But thanks a million and all the questions. We do appreciate all of you for listening and tuning in and asking questions. It's been fantastic.
Thank you, everyone, and cheers. Na zdrowie from my side, and up to the next 100, Derek, and also all our audience and listeners.